Welcome to the Possible Promise Podcast. Every Monday, Wednesday, and Friday, we go live to break down the complexities of finance and point the way to financial success. Today is June 19th, 2020, and I am your host, Brandon Oliveris.
And I'm Christine, his wife.
This is episode 4, The House Always Wins. Welcome everyone. That time I both forgot the time we go live and I almost forgot our tagline. I'm still obviously figuring this out.
Noon at 12.
12 p.m. Eastern, and it wasn't a mistake. I said Wednesday. So the first announcement, first of all, is that we are happy to announce that we will now be having our shows or episodes on Monday, Wednesday, and Friday. So I'm a little nervous about it. But I'm also very excited. I've been wanting to do that, and I know it's kind of early on, but it just feels like a gap in the week. You know, we talk about the beginning of the week, we talk about the end of the week, but we're not really talking about the week in progress. So we're going to experiment. If it doesn't work, we can revert back to this format, Monday and Friday. But for now, we are doing Monday, Wednesday, and Friday at 12 p.m. Eastern. And you can always tune in to our live shows at possiblepromise.com/live. So that's pretty exciting. I'm excited about that. So,
and it's okay if you're a minute late, because we always start
late. Yeah, so yeah, sorry we're a minute late.
We're always a minute late.
I jostled the computer by accident. I unplugged my microphone, and then the speaker app wouldn't reuse my microphone, so I had to close it out and open it back up and make sure everything was configured, and it was a really big pain. So that was...
It happens.
It's Friday. Well, that was our excuse on Monday, too, but it's Friday. It's, whatever day it is. It's Friday. It's Monday. It doesn't matter what it is.
Hump day.
It's Wednesday,
There's
no always winning. An excuse.
We can't win.
So, yeah, I'm really excited to do our extra show, though. I think that'll be cool. And... Yeah. Because we kind of need an extra segment, so we're moving our weekly Ask Possible Promise segment to Wednesdays, and instead on Fridays we're going to do the Week in Review. And that will basically be where I talk about what happened this week in the market and what happened with my own personal trades and the stocks I talked about on Monday and that kind of stuff.
So you can humiliate yourself?
Yeah, no, thanks. You have so much faith in me. So... Yeah, that is, that will be, sorry, I'm opening up the page I'm going to need in just a second. That's our new segment, is Week in Review, which we will do in just a few minutes. But, in the meantime, let us look at the indices. Last I looked, they were well off of their highs. They started up a good percent and a half.
Sounded like that said ISIS.
Oh, indices, because I typed ind... And then I hit tab to autocomplete, and it says it finished the word.
I know. It was just funny.
Okay. Well.
Go ahead.
So, yeah, we're down. This is the data I get is like 15 minutes delayed. So, but anyway, the S&P it's still up about 14, 15 handles.
Handles?
Handles, yes. That's what each point is like a handle. Let's just...
Well, not everyone knows that.
Oh, I'm sorry.
It's
not 14 or 15 points. Just shorthand, I don't know. About 46 basis points. A basis point is 0.01%.
Thank you.
Yep. The Dow is, let's see, up about 125 points. Also just about the same, 48 basis points. The NASDAQ... back over 10,000. Oh my gosh. It was not above 10,000 yesterday.
Above or below?
Above 10,000.
It sounded like you said above.
Sorry. That was... You're just gonna pick on me today.
Not intentionally.
Oh, sorry, yeah. Up about 62 basis points. So NASDAQ up above 10,000 once again. That was kind of its big breakthrough. Was it earlier this week or last? I think it was last week. So it's back above that. It's been below 10,000 all week, so that's pretty big. And the VIX is down about, down 5%. So that's pretty big. So things are, like I said, they're down from where they were this morning. Now today is what is called triple witching.
That's right. You're gonna
Yes, I warned you about this term yesterday. Triple witching, which I just love that term. Or if you look at it, you can consider it quadruple witching. There are lots of things. Basically, triple witching. Tons of things are expiring today. Monthly options are expiring today. It's June 19th, third Friday of the month. Index futures contracts are expiring today. And
it's also Juneteenth today.
it is Juneteenth. Yes. And index options are also expiring today. So we have three things expiring today, and that's called triple witching. So the significance of that is that it tends to be more volatile because you have people either exercising their options or rolling forward their options to another month. And so there's a lot of activity going on in the market. And so it tends to be very volatile.
And it happens 4 times a year?
4 times a year, yep. March, June, September, and December. Third Friday of the month. So
I wonder why. Do they just choose that, or is it just...
third Friday of the month? Well, that's options always... monthly options always expire third Friday of the month. That's just kind of how that is. I mean, is it arbitrary? Probably. I mean, it's just kind of how it is.
I just wasn't sure if, triple witching is a thing or something,
Yeah, it's a thing.
No, I know, but, how's that even start?
Because everything expires on different dates, and so it's just... they all kind of come together 4 times a year, and that's,
okay.
So it creates volatility in the market.
Okay.
And of course, the last hour of the day, I just love it, is triple witching hour.
I love that.
It's just awesome. I mean, whoever came up with that, and I don't know who it was.
They're pagan.
Whoever came up with that is brilliant, and I love it.
They're pagan.
Probably. So, probably not actually. So, today is triple witching, some volatility going on. This was a quiet week, and I kind of said it was going to be a quiet week. It just kind of was a quiet week, and I'll talk about that in just a second with the weekend review, but, we had some movement, but to this week overall has been pretty quiet. So,
for a change.
Yeah, it's been good. I mean, it's kind of slid down, Tuesday it jumped up, and then it's kind of slid down most of the week, except for today it opened up higher. But again, today we're sliding down, so, I mean, today we opened up, 1.5% higher.
Well, it's going to be volatile today, though.
Yeah, now we're only up 0.5% or so. Who knows what will be this afternoon? I mean, yesterday it was choppy, up and down, negative, positive all day. It was just, yesterday ended just a teensy bit higher. Just right at the end of the day. So it's been kind of a very quiet week, low volume week, which is very unusual for triple witching weeks, apparently. Usually there's a lot of volume, usually there's a lot of volatility. But
that would make sense.
This week's just been kind of quiet, so, which I won't complain. As option sellers, which we'll talk about later, quiet markets are kind of what you want. I mean, you want volatility, but when we have where it's not really moving much day by day, that's also really nice. So that's pretty cool. So I'll get right into it. We're going to get into our week in review. Brand new sound effect and everything.
Yep.
So, and it's life approved. I showed her, hey, what do you think of this sound effect? And she seemed to like it. So
I do.
So
it fits the theme really well.
It does. Okay, so real quick though, trivia. Christine has perfect pitch, and so I play this sound effect. She's like, "That's perfect. It's in D too. D, right?
Yes.
Yeah, it's in D also. The key of it is in D." I'm like, okay, and well, Monday's sound effect is in D. Oh, I didn't know that. So we went through all the sound effects for this week, or for our different segments, and like 2 or 3 of them were in D, and one of them she couldn't really figure out because it didn't really have
It was
a
a
key.
weird, yeah.
But
And
so
then the intro and outro are in similar keys.
what key are they in?
F, I think.
Thank you. So see, she's perfect pitch.
I have to hear it again though. But
So it's you just heard it a few minutes ago.
I know. Well, that one is. Actually, now I have to pay more attention. It might be.
You'll hear it at the end.
Might be in C. Sometimes it's hard to tell what key
I
something's
know.
in.
So she was like, "Yeah, it's in D. That's perfect." I'm like, "Okay."
It was a perfect theme. It like kept with the theme.
Yeah. Anyway, so this week, so if you are watching live at possiblepromise.com/live, I put up, and I again, my programming skills coming in handy. I programmed this literally. Okay, so
Of course you did.
right, like in the last hour and a half before our show, I programmed this, and literally, and around lunch too. I had lunch before we went live, and I told Christine, "Hey, I'm trying to do something. Don't distract me for like 10 minutes," because I really wanted to get this done. So what I did is I created a little script, a little chart. It dynamically updates with the data from today. So that's pretty cool. And so if you're on that page, and it will be on the show notes too, it'll be at possiblepromise.com/4, number 4. I will put the chart there too, but it'll be static by that point because by the market will be closed. So, but right now we're live, and I have live data updating our chart every 10 seconds. So that's pretty cool.
We'll only do that during the podcast, or if
It'll do it all day.
if you go to that place.
All day. I mean, I'll take it down by the end of the day because there's no point.
Oh, true. I guess
It's just going to show this week. So the chart shows it's a candlestick chart of the S&P, and it just shows the price movement this week. Just so you can kind of get a good idea of what I'm talking about. And so I like charts, so I'll do that quite often. If you're live and I want to show a chart, I will put it up there. And that's all, like I said, live data. I'm pulling that from an API, so go programming.
yes.
And on the show notes, I'll put a static chart there. And so I like doing that. I can't see it because I'm blind, obviously, but I know people like visual elements, so there you go.
And he makes sure that it looks good and everything.
Yeah, I do. I get sighted assistants like, hey, tell me what's going on. And getting a sighted person, but one who does not know about stocks, to describe a candlestick chart. Yeah, there's a blue bar with little lines coming off. Okay.
They try.
They really do try. So that's... Anyway, so what I wanted to point out, though, the reason I wanted to put this chart in there, and I have for myself, because I have to look at the raw data, like I said, so I have Yahoo Finance open with the raw data for the S&P. But what I wanted to show, so Monday was an up day, obviously. Let me see where we were. Monday, we were well underneath where we are today. We opened up below 3,000 Monday, closed a bit above 3,000 on Monday. Tuesday there was a big jump in the morning. The open was around like 3130 for the S&P, 3131. And that was because of a few things. So retail sales came in on Tuesday at I think it was a plus 17.7%, which was huge. It wasn't really expected to be that high. I think
Probably because the retail stores are open.
Right, they're opening up again. 8% or something was expected. 17.7% was the actual number. There are some other things. The president's trying to push through an infrastructure bill for updating our infrastructure in the United States. That probably won't get through anytime soon, but people like it anyway. And the big thing was that I don't know if you heard about this, Christine, but there was a new drug they found, a really cheap steroid called dexamethasone, which was found to significantly help with the coronavirus. People who had the coronavirus, and who had it really badly, who had really, were pretty chronic. It cured, I think, about a third of them.
Oh, that is amazing.
Yeah, so that was, and the cool thing is it's really cheap. It's very prevalent,
And it's already being made already.
Right. So it's a steroid that already existed, and they just kind of found that it helped. And so that was pretty good news. So obviously, it really jumped up high on Tuesday.
I did not know about that.
Yeah.
Huh.
So, but then, Tuesday, it opened up higher. Again, it slid down all day. So again, we started around 31.31, closed at 31.24. But it went significantly lower throughout the day. I think our low for the day was under 3,100, 30.76. So it was a lot of price action Tuesday, a lot of chopping up and down. A lot of the reason behind that, Powell was talking in front of the, I think it was the Senate, I don't remember. But he was talking on Tuesday about the economy, and just like last week, he's optimistic but also kind of reserved about it. So people don't like his tone so much about that. Wednesday and Thursday were really quiet, also kind of just sliding down. A lot of it didn't go down significantly all week, but it just kind of stuck around where it was. Yesterday was, like I said, a very slight bit up. Today jumped up in the open. I'm not really sure why exactly, just besides triple witching, but today again has been sliding down. So that's been the week this week overall. And like I said, it's been very good for options trading because, and I'm going to talk about selling options later on, because you want it to trade in a range when you're doing, when you're selling options. So for me, it was really good. I think I've gained so far, the week's not over yet. So far this week, about 6%. And I had some really, so I had, some of these terms you might not know about yet. Iron Condor. Christine knows about that because I talk nonstop about it.
I have to live with him.
Yeah.
So
I had an Iron Condor on Gilead, and I had it open for the last month. And finally, it was just kind of, ticking down. Finally this week closed out at my price target. I take 50% profit when I can on options. So finally this week that closed out. I just had this morning on XBI, which is the biotech ETF, close out.
Oh, that's good.
HYG, which is a bond, corporate high yield corporate bond ETF, close out today. Earlier this week, XLK, which is the tech ETF, close out earlier this week. I just said that. And one of the best ones. So Wednesday, I opened up a call credit spread on JD, and in one day it hit my target. It was awesome because it dropped right afterwards and hit my target, so that was perfect. So this week's been a really good week for me. Now our stock picks, so the PennyMac pick was just PFSI. Let me see. I know it's up today, or it was when I checked. Let me see how it's doing. Oh, now it's down. It was up before. Only 4 cents. But it's... Okay, so down 0.09% today. But... Let me
it's
see.
because you're talking about it.
I know. It's like, oh, yeah. You want to show off? No. But my position in it is up 8% this week. So I got a good gain in it. That one's doing well. Okay, so CarMax I have a bone to pick with because they beat earnings. They really did. Let me see. I have it. So this is for first fiscal quarter. 3 cents gain over an expected 6 cent loss. So that's not as much of a beat as we were thinking, but it's still a beat.
It's something.
And revenue of
Reverend.
It's REV.
I know.
It's our screen reader. 3.2 billion versus 2.6 billion expected. So good news, but it's down 4%. So that's disappointing. I'm holding on. I'm holding on to it and just going to see what happens. Lennar had a really good week. Let me see how it's doing today. LEN, that was last week's, but I was still holding on to it this week because this week was actually the earnings. It beat earnings. Let me tell you what it's up today first. At least, hopefully, it's up.
Yeah, really.
Don't disappoint me, Lennar. No. Okay. Down almost 2% today, but
like I said, it's because you're talking about it.
I know. I'm going to stop talking about it. No, but they beat on earnings. It was up all week though, so it's probably profit taking. So $1.65 per earnings versus $1.29 expected. And they had revenues of $5.3 billion versus $5.29 billion. So right around what was expected. So they did beat. They had a lot of good stuff going on this week. They had a lot of analyst upgrades earlier this week. A lot of analysts upgrading or upping their price targets to $71. I saw it $76. So, it's trading $60. So, I mean, actually, no. You know what? I'm not. Okay, so I forgot. I sold out of it earlier this week. Because. Sorry, that's my dog sneezing. I sold out earlier this week because...
Of Lennar?
Of Lennar, because it was doing really well, and it was starting to slide a little bit, and I'm taking my profits. I got a good 5% profit. I bought in at like 61.14. I sold out at 64.25. So I got a good 5% profit there. I may buy back into it. I think it's just a little bit of profit taking today. There's no bad news or anything. So I may... My dog's just sneezing. I may buy back into it maybe today or maybe Monday. I don't know.
Just depends on how it does. And
see how it does. Because I think there's a lot of upside. I really like the stock. I didn't know about it before I found it in the earnings reports that were coming up. I didn't know about it, but I really like the stock. They have a lot of good stuff going on. So I may buy back into it and just hold it. So that was my week. And the week in general for the market in review. I think that's about all I need to say about it. So who knows what will happen today. It's been kind of, like I said, a crazy day so far, but a really quiet week. So we'll just kind of see what happens. I'm curious, actually, where we are now versus where we were earlier. Let me see. Oh, wow. Okay, so as I was talking... Yes, that's why everything's down. Okay, it wasn't my fault. It's the S&P is down 58 basis points. So,
and what was it at first when we were?
It was up about 0.5%.
Oh wow!
Now it's down about 0.5% or 0.6.
0.6. I love your.
What?
No, how you're so
sorry.
specific.
Well, it's what it was. So we're down about 17 points. Wow, that's the kind of day we're having.
That's why everything else is down.
Which I'm glad. I mean, I'm pretty neutral in my portfolio. We're going to talk about Delta Neutral one of these weeks. Not next week. I have planned out already, but one of these weeks we're going to talk about Delta Neutral, and I'll tell you why it's important. But I'm pretty Delta Neutral in my portfolio. But I always appreciate a good down day because I have some call credit spreads, which I'm going to talk about in a few minutes on SPY, which is the S&P 500 ETF, right around just 2 or 3% above where it is now. So I appreciate when it's going down because it gives me a little more breathing room. So I'm always glad for a down day. Anyway, so now we will get into our topic, which is The House Always Wins. Now, what key was that?
A minor, I think. It's
Good.
hard to tell.
I know, that's the one that was hard to tell. Okay.
I would have said A minor, though. Or C major. It's the same thing.
Cool. So, The House Always Wins. So, what we're talking about here, Monday, we talked about buying options. And just to review, I mentioned that there are 3 things you need to get right to buy options. Number 1 is the direction. Number 2 is the distance. Number 3 is the length of time. The duration, I guess you could say. I should have thought that's very much more terse than length of time.
You are very terse.
I try to be. I'm saying that's a better word than length of time. Duration.
Yeah, who cares?
Like direction, distance, and it's the 3 Ds. Oh, I'm so upset. Now I want to go back and redo Monday. Direction, distance, duration. I am so upset at myself.
Oh, well, now we can start using
So that's... I meant to say that... No, I didn't. That's a lie.
No, you didn't.
Direction,
Nice
distance,
try.
duration. You need to get all 3 correct to profit when buying options. Okay, so...
That should be an actual thing, the 3Ds. I thought it was somewhere.
It's really not. That really just popped in my head. I mean, if it is, then I don't remember. My subconscious is just popping it up for in my favor.
Cool.
Anyway, so so that's what you need to get right when you're buying options. Remember that options basically control 100 shares of a stock. A call option gives you the right to buy 100 shares of that stock at the given strike price. A put option gives you the right to sell 100 shares of that stock at the strike price. And so that's basically what we talked about on Monday. Now, one thing I didn't mention Monday, what happens... So we'll use the same example. We had that $100 stock. You have a $100 strike. And let's just say it's a call option. Right? What happens if by expiration, whenever that is, the stock is trading less than $100? What happens is that option expires worthless. What that means basically is that it has no value, it's worth nothing, and you just lose all of your money that you put into it.
You said it's less than $100?
If your strike is 100 and the stock is trading under 100 on
then
expiration, then it's worthless. Similarly, for a put, if your strike is 100 and the stock is trading above 100 at expiration, it's worthless. Okay, that just means, again, it doesn't have any value. You lose your money you put into it, and that's it.
Huh.
So that seems bad, and it is, but the good thing about options, you can only lose whatever you put into it. That's all you can lose. Okay? You can't lose anything more. With stocks, it can go to 0. I mean, generally won't, unless you're being stupid and trading in bankrupt companies, like some people are today.
Yeah.
We're going to talk about that Monday. I have a whole rant prepared for that.
Oh, darn it.
So... Generally, a stock's not just going to go to 0. If you're trading in Apple, it's not going to go to 0.
No.
But, there's no really limit as to how much you can lose on the stock, right? I mean, you don't know. Something black swan event could happen, like with the coronavirus in March, and you could lose 20% value.
Black swan?
I'm sorry, yeah, I thought you knew that term. Black swan event is any event that you didn't see coming.
Okay.
Basically, a huge... catastrophic event that just came out of the blue. You didn't see it coming.
I don't know if I remember, but I don't know if everyone else knows.
Oh, that's cool. So, you could lose 20, 30, 40% of a stock, sometimes overnight, sometimes in a few days, and lose a lot of money. Whereas with an option, you can only lose what you put into it, which is never as much as, what actually 100 shares of that stock would cost. So, if you put $500 into the option, all you can lose is $500.
Right.
Which stinks, but it's...
But you can't lose more than that.
You can't lose more than that, exactly. So, a lot of people say, again, options are risky, and there are all these cautionary tales, one of which we will discuss on Monday. But a lot of them are just really exaggerated. You cannot lose more than you put into options.
I think a lot of it is because... And I know I'm kind of getting ahead of myself, but there's no education.
Right, yeah.
So people do stupid things, and they get themselves into trouble because they didn't know better.
Yeah, exactly.
Because there's not anything out there.
Or because people treat it like it's a game, which, again, that'll be Monday's topic. Investing is not a game. It's really not. And some people treat it like that. Today's title notwithstanding, the house always wins. Casino reference, obviously. But... that's just for a metaphor, but it's really not a game. And it needs to be taken seriously. But you can only lose what you put into it.
Yeah.
You can't lose more than that. So options, I mean, yes, they're risky, but I don't know, not horribly so. If you know what you're doing. So that's what you need to know about buying calls and puts. But when you're buying it, I mean, okay, so this is logical. When you buy a stock, someone has to sell it to you, right?
Well, of course.
Right.
You can't just buy it.
Right. I created the stock out of nothing. So, similarly, when you are buying a call or a put contract, someone's selling it to you.
Yep.
Now, someone could be selling it because they already own one. So let's say, you own a call contract and then you want to sell it because you made profit or because you lost too much, you don't want to lose any more, and so you sell it to someone else. That is possible. But it's also possible for someone to sell an option without owning it. Okay? That's called, we call that writing an option contract.
That is so weird.
It is, but, when you think about, you can't sell what you don't have, it's weird. But if you think about it more as this is a contract between two parties.
You're selling the contract.
You're selling. You're on the selling side of the contract. They're on the buying end, and you have an agreement.
So you're not really selling the option. You're selling the contract.
Well, you are. I mean, you are, but you don't need to necessarily own it first.
Okay.
Right? So yeah, but that's a good way of seeing it. So for option sellers, this is something, when I first got into options, I was all into buying, because, buying options, you can make a lot of profit, okay? And you don't necessarily have to put that much money into it first.
And you did, too.
I made, before the crash from the coronavirus, I was making a lot from options. It was really easy.
But you also lost a lot, too.
I also lost a lot, God. Tesla, I cursed Tesla, oh my God.
That's right. Was Tesla.
Yeah, oh god, yeah, Tesla. Those are some stories, but like I said, you have to have three things correct. But if you do, you will really profit. Mm-hmm. You can really, really profit with options. You can gain 100%, 200%, 300%. There's not too much of a limit as to how much you can gain. Okay, and there's a limit as to how much you can lose. So it seems pretty cool, but the actual probability of winning is pretty low, 50% or less, depending on what kind of option you buy. With selling options, you can control much more accurately your probability of profit, your probability of winning. Okay? And when I sell options, I aim for about a 70% or more probability of profit. So basically that means, and it's very accurate, if I sell 1,000 options, I should win about 700 of them. Now, there are things you can do like managing winners and adjusting options, things like that. You can really easily get that up to 85, 90%. Okay, so imagine winning 80 to 90% of the trades that you make. Well, that's everyone's dream, right?
Well, yeah.
Now, the caveat is, of course, because where there's higher probability of profit, there is lower actual profit potential. Okay?
What does that mean?
Because, investing is all about risk. The higher the risk you take, the greater the profit you can get.
Yeah.
If you lessen that risk by saying, I will win 70, 80, 90% of the time, then you just don't get as great of a payout.
That makes sense.
Right.
Yeah.
But, one of the greatest lessons I've learned with investing is it's about, and we talked about this, right? The small, consistent gains.
Yes.
And so you win 70, 80, 90% of the time. Maybe it's not as much for each trade, but it still adds up. Okay, like I said, I made about 6% this week. Now, let me tell you, and I'll talk about this Monday a little bit, but be careful. You can get into these Facebook groups or, Reddit or Twitter where you'll see people saying, I doubled my account in like 1 week or, 2 weeks or whatever. And yeah, that's what buying options can do sometimes, but they won't show you when they almost always lose all of that.
Yep.
Okay.
It's easy to do.
It's really easy to do. And so they'll show you like, oh my gosh, I doubled my account in just a week or two, but when the market goes against them, they're going to lose big. I told you in, I don't remember which episode it was. I think episode 2. I don't remember, but about I've heard people losing 30% in a day.
Yeah, I think that was early on.
Yeah. And so, that just shouldn't happen. But
Right.
that's the kind of thing that can happen when you don't know how to manage your risk. We're going to talk about risk management in a future episode for sure. But on the selling side, no, you're not going to have like huge days where you win, where you double your account in a few days. That's not going to happen.
You're more of a seller, right?
I'm more of a seller. So, like I said, early on, I was more of a buyer. I've transitioned into more of a seller because it's just more sustainable, more consistent profits. No, maybe you won't double your account, but you also won't lose half of your account in a day of bad trading or something. It's just steady, consistent gains. Mm-hmm. Not to say you can't lose. You can always lose, but, it's just less likely.
Right.
So, think about it. So there has to be a buyer of an option and a seller, right? Now, if you are the option writer, as I said they're called, the option seller, the option writer, you're on the opposite end of that contract. So let's think about it with calls. I said that calls are a bet that that stock will go up by a certain amount, right? To at least the strike price or to at least the break even, the strike plus the premium. And the buyer pays a premium to secure that right to buy that stock at the strike price. Okay. Now, what would the option seller do? If you are entering into an agreement, let's just take out the software and all the how you actually perform the trade, and let's just say there's two people, and you say, hey, I think stock A is going to go up. It's at $100. I think it's going to go up to $110. If I pay you $5, would you allow me to buy 100 shares of that stock at $100 1 month from now? Okay, that's what you're doing as an option buyer. And the other person says, oh, sure, Now, why would they do it? They don't do it out of the goodness of their hearts. If they think the stock's going to go up too, they're not going to do it. So why would the other person sell that or write that option to you? Why would they do it? Well, they have the opposite assumption as you. Okay? And someone is always going to be right and someone's always going to be wrong. That's why they call it a zero-sum game.
That's right.
So if that person's selling the option to you, then that means, what do they think is going to happen? Either, so you think it's going to go up above $100. They think
it'll go down.
That it will go down or
stay the same.
Or, okay, so let's use another example. Let's say the stock is trading at 95. You buy a call option for a $100 strike, because you can do that. It doesn't have to be at the current price. Okay. Uh-huh. So if the stock's at 95, you buy call at a $100 strike. So they think either it will go down or at the very least it won't go over $100. So if I'm the seller of that call option, I'm saying, okay, I'll sell that to you. I think the stock will either stay put or go down. So I'm neutral to bearish on this stock. I think within a month it will not go over $100. And as the call buyer, you think, oh yeah, it's definitely going to go over $100 plus my premium, right? That's how the contract works. So it's not purely bearish. It's not purely saying I think it'll go down. It's just saying I don't think it will go up above the strike price. That's a really important caveat because, you can, as a seller, there are lots of ways you can win. Let's say that stock's at $95, okay? If it ends at $90, you win. If it goes down. If it ends at $95, which is unchanged, you win. If it ends at $98, you win. Because even though it went up, it didn't hit your strike price.
That is so cool.
Okay? If it ends at, and this would be really sweating it, but $99.99, you win.
Whoa.
Right? Now, guess who that premium is paid to when the option buyer buys the contract? It's paid to the seller. So the seller collects a premium upfront, and if the option expires worthless, they get to keep 100% of it. That's the magic of selling options. That's why it's so awesome. It's really cool. Okay? So... sorry, the dog's just doing this thing. That's how selling calls work. Now, the thing about calls where you have to be careful is, so the call buyer says, I want the right to buy 100 shares of the stock at the strike price by the expiration date. Okay, and you say, sure. So what does that mean? If you are that seller and the buyer comes to you and says, hey, the stock's selling at, or the stock is trading at $105 or whatever. I want to buy that stock now at 100. You have to pay up. Right? So you have to say, okay, I'm selling you 100 shares of the stock at $100. I'm losing $5 per share. Or whatever it is over 100. Now, guess what? You don't get a choice in that matter. As the seller, you have the obligation, in the case of call options, to sell that stock at the strike price if the buyer so chooses. Okay. So they have the right to buy that stock at the strike price. You
Why
have
is
the
that?
obligation because they're paying for that right. So it's like, okay, think about the insurance example.
Uh-huh.
If you called up your insurance company and said, hey, I need my car fixed, and they said, no, you paid all that money, but we don't have any obligation to fix it, would that be worth the price?
No.
They have the now, of course, insurance companies can find ways of weaseling out of it sometimes, but let's just say it's simple. You pay the insurance premium, you call up the insurance company, and you say, hey, my car is broken, I was in an accident, whatever, I need it fixed. If they came back to you and said, no, sorry, you would say, well, what did I pay all that money for?
Right.
Right? That premium was paid to secure the right to, in the case of insurance, to fix the car.
Right.
And the insurance is obligated, just in our hypothetical universe, to say, okay, it's going to be fixed, right? They have to pay up. Mm-hmm. So as the option seller, you are obligated to, in the case of call options, to sell that stock to the buyer at the strike price. You're obligated. You don't have a choice in the matter. Okay?
Huh.
And, if you don't have that stock in your account when that happens, I mean, that's a lot of bad things can happen. You can, basically, if you have to sell 100 shares of that stock, it's called a naked call if you don't own those stocks, those shares. Okay? So what you can do, basically, it's a strategy people use. Let's say you own 100 shares of a stock and you sell a call against those shares. So if you get it's called being assigned. If the buyer comes to you and says, hey, I want 100 shares, then you have to sell those shares. If you don't have those shares, then you're sort of out of luck there. you have to buy those shares and then sell it. Okay. So that is, you are obligated. Now, they may not come to you and say that. Like, if it trades under $100, they're not going to come to you and say, hey, can I buy it at 100? Because that would be stupid.
Yeah, I wondered that.
Right. So if it expires worthless, you keep everything, and that's it.
So it's only if it's 100 or higher?
Yes.
Okay.
In almost all cases. There are some cases where if it's close to the strike price, they'll do it anyway, especially during expiration week or during earnings or, dividends.
Okay.
If they want the dividend, it's the ex-dividend date when, they have to own the stock to get the dividend. Then they might come to you and say, hey, I want to buy these stocks, these shares. So for the call seller, you are obligated to sell 100 shares of that stock if it trades at the strike price or above, or if the buyer exercises the contract. For the put seller, the put is the other side. So remember, if you buy a put, you're expecting the stock to go down. And a put gives you the right to sell that stock, 100 shares of that stock, at the strike price. So I gave the example of the insurance company.
Right.
So if a put gives the buyer the right to sell the stock, what does the seller of the option have to do?
Go below?
I'm saying if the buyer wants the right to sell their stock, what does the other party in the contract have to do? They have to buy it.
Okay.
See what I mean?
Ugh.
So
my head is spinning.
I'm sorry. I know. I'm trying to So with the call options,
they sell it.
You want the right to buy the stock, and so the seller of the option, or the writer. Let's just use the term writer, so we're not using seller all over the place. The writer of the option has to sell it to you.
Okay.
But a put, you have the right to sell the stock. And so the option writer has to buy it from you.
Oh, okay. So,
right?
So we're switching
It's just
roles.
the inverse of the call option.
Okay.
Right. So let's take, stock A is trading, let's say, at $105. You buy a put at $100, and the option seller sells it to you. Now, what's their assumption? They, just like the inverse of the call, they think it will stay above $100. So they're neutral to bullish. Right? So you sell a put if you think a stock will not go below a certain price. And if it trades above $100, then it expires worthless and they get to keep the premium.
Wow.
Yeah. So what's really common is people will sell puts, and if they want to buy a stock at a certain price that they think is worth it. So let's say, again, stock A is trading at, $105. And they say, yeah, that's a little pricey, but I would buy it at $100. So they might sell a put at $100, and so they're not necessarily upset even if they get assigned on that option, because they might want to buy it at $100, right? So, I mean, there's all sorts of ways it can happen.
I thought assigning was bad.
Assigning can be bad, but not always. So if you are the option seller or the option writer...
Oh, yeah.
And... and you really want to buy a stock at a certain price, but the current price you think is a little high, right? You could wait until it goes lower and then buy it, or you could sell a put at the price you think is worth it.
Right.
And you might sell it the first month and it doesn't hit it. You might sell it the second month and it doesn't go down to that level. You might sell it the third month and it doesn't go down to that level. Eventually, let's say after 5-6 months, the stock goes down to your level and you get it signed. You get to buy that stock at the price you set. So it's a really powerful way, if I want to set my own price, that I can make money in the meantime until it gets there. So it's not always bad to be assigned. It's bad if you don't expect it.
Yeah.
You don't want it, right? So that's how that works. So the reason that it's powerful to be an option seller or an option writer is because, again, let's say for the put, it can be at 110 and you keep everything. It can be unchanged at 105 and you keep everything. It could be 102 and you keep everything. Only if it goes to 100 or lower do you lose out on that trade. Okay, so whereas for the option buyer, everything has to go right for them to win. As the option seller, not very much has to go right and you'll still win. Right? Direction is very flexible. The distance is extremely flexible. It's like, instead of saying it has to go this distance or farther, as the buyer does, it's saying, as long as it doesn't go past this point, I'll win.
Right.
Right? And the duration, it can't do it by that time. So, as the seller, almost everything is in your favor, which is really awesome. Right? So, and we'll talk about in the future how you can set probabilities. You can look up the probability of profit of an option. But if, let's just use an example. So, if you have a stock, you're looking at a stock, you think, the stock's been trading pretty high. I don't think it'll go above, $5 above where it is now, right? So then you can say, okay, I'm going to sell a call option against this stock, and as long as it doesn't go above that point, then I will win. Mm-hmm. Right? Now, there are lots of other things. There are options, spreads. We're going to get into all that next week. But this is just the basics of how option selling works and why it's so much more powerful than option buying. Because not much has to go in your favor for you to win. Mm-hmm. Right? Except
if the buyer, or so they want to buy.
Well, yeah, if they exercise their contract, then you're out of luck.
Yeah.
But that's okay.
But that doesn't happen too often.
It doesn't happen too often. As long as you manage it, as long as you close out that trade, if it's not going in your favor, either, close out the contract or, roll it out to a future month. There's lots of stuff you can do, and that will all be stuff we talk about in the future. But if it's in your favor, then there's so many ways you can win. Not a lot of stuff has to happen for you to win. But, again, so the downside... Oh, it's raining.
Oh, I didn't even notice.
Yeah, so
it's about time.
Huh?
It's about time.
I know.
We haven't had rain here.
So the downside is, let's take that stock A example, okay? And you sell a call against it because you don't think it's going to go over $100, mm-hmm. right? And maybe it's at 95 right now. And you sell that option for $5 per share, so $500. It's 100 shares. Whereas the option buyer can make a lot more than that $5 they put into it. You can't make any more than $5 per share. Mm-hmm. That's your maximum. Right? And you have a higher loss potential because, and we'll talk about that in the future, but your profit is capped at the premium you receive for selling that option. You can't get any more than what you receive on day one.
Because you sold
it, right?
Yeah.
You can't be like, oh yeah, okay, now you have to pay me more. It doesn't work.
Wish it did.
You're capped at whatever you sell the option for. So that's why it's kind of less profit, but it's higher potential. Like, more probability that you're going to win.
That makes sense.
Yeah, so there's a lot to it, and we will break this down a lot more in the future. I know there's... Poor Christine sounds so confused.
I'm getting there, but...
I know. It's a lot, and...
This is a podcast you might want to listen to a lot.
Yeah, so I'm just going to summarize quickly. So, just... If you think about what the buyer is doing and think about, okay, if someone's buying it, why would someone sell it to them? So again, if I'm buying an option, or let's say someone's buying an option from me, why would I sell it to them? Well, I would sell it to them because I don't think the stock will go above a certain price by a certain date. So whereas the buyer has, direction, distance, duration, I have that, but instead of it has to go in this direction, by this distance, by this duration. As the seller, it's sort of more like it can go any direction except that direction, except for that distance and by that duration. So, for that $95 stock, you sell a $100 call against it, right? Mm-hmm. You're saying, okay, so the call buyer is saying, I want it to go above 100, by the expiration. And you're saying, I don't care what this stock does as long as it doesn't go above 100. It could go down, it could stay the same, it could go up a little bit. Anything's fine as long as it doesn't go over 100. Now, just logically, who's more likely to win that bet?
You?
Yeah, the seller.
Yeah.
Right. The caller or the buyer has all these things they have to get right. They have to make sure it goes over 100. And they have to make sure, first of all, that the stock actually goes up. Second of all, that it goes up enough. Third of all, that it does it by the expiration date. If they're wrong on any of those things, the seller's going to win.
That's crazy.
So it's just, you're more likely to win in almost every case. So many things are in your favor. Now, that doesn't mean I never buy, but as a seller, so, people might say, like, how do you know what a stock's going to do? Well, you might not. I mean, you kind of get a sense for what you think it might do if you study a stock enough. But if you aren't willing to bet on all three of those components of an option, direction, distance, duration, then it's better to sell. Because if you sell, you might say, I don't know if it will go up or down. I'm pretty sure it won't go past this point, though, because stocks only move so fast, usually. Pretty sure it won't go past this point. I could be wrong, I'm pretty sure. So you just have a lot more wiggle room as a seller, right? You just have a ton more wiggle room, and you can say, yeah, I don't think it's going to go past this point. And, if I'm right, then I'll win. That's sort of how it works. So, I mean, there you go. That's why it's a lot better to be a seller in almost every case, unless you're really confident about the direction. Because as long as it doesn't go absolutely, totally catastrophically against you, you're probably going to win.
So is that why the house always wins?
That's why the house always wins. Thank you. Because, like I said, when you go to a casino, you are betting against them. And they have basically all the probabilities in their favor, right? They've piled every possible thing in their favor, where, yeah, you might win, and you might win big, but overall, in time, you're probably going to lose. But the house, the casino, they're the ones making the money.
So the sellers are...
So just as that happens, so the writer of the options, the seller of the options, they have everything stacked in their favor. And yeah, I mean, sometimes they might lose, but overall, in the long run, they're going to win. Right? It's just how it works. And that's a definite. That's not, maybe, like if you, like I said, target 70% probability of profit, you're going to win 70% of the time or better. There's no ifs, ands, or buts about that. Right? That's just how it is. So you're the house, you're the casino. The buyers are the ones gambling, and you're just raking in the profits. So yeah, you can win. It's okay if you win sometimes, but more often than not, I'm going to win, and I'm going to win more often, and I'm going to have an edge over anyone else who's buying. So that's why I'm saying the house always wins.
That's
so
awesome.
I know that was kind of a lot. I'm sorry about that. I think I lost Christine somewhere a while ago.
I kind of get it.
I know. And so,
it's too many numbers.
If you have questions about this, it's so hard. I try to break this down as best I can. It's so hard. I'm really trying to. If you have questions about this, go ahead and ask. You can go to possiblepromise.com/4. This is episode 4. And comment there, ask your questions, and I'll answer you. I won't feel free to answer. You can feel free to ask. Feel free to ask. I will answer. And that's no problem. And I will break this down more in the future. We're going to talk about option spreads next week, but this is just to give you an idea of what's available out there, why option selling is so much more powerful than option buying, and so that's basically it. So I hope that you enjoyed this and that this made some degree of sense to you. And if not, I'm very sorry. But we will see you next Monday,
Yes.
where we'll be talking about why investing is not a game. So with that, I hope you have a great weekend, and we will see you in a few days. Thank you for listening.
Bye.
Bye.